Hello, this is Dave Clayman. It is noontime on Thursday, March the 28th. You are here for our March 12 Points webinar, the Taxman Cometh, Strategies to Minimize Your Contribution to the Government. Looks like we've got a few light of the number of attendees we were expecting, so we're going to give everybody just a couple of minutes to get on the line, and we will be right back. Thanks for holding. Okay, well, it looks like most of the registrants have signed in, so welcome. Again, this is Dave Clayman. I'm the CEO and co-founder of 12 Points. And this is the March webinar, the Taxman Cometh, Strategies to Minimize Your Contribution to the Government. So, unfortunately, Brian DeLugash, our CPA who was scheduled to join us today, is still ill from last week. So, but we didn't want to make you wait any longer. So we are here. I have got all of Brian's notes and we are ready to go through the presentation. So let's roll. So again, that is myself. I am the CEO, as I mentioned, and have been in financial services for 20 some odd years now. And we are looking at ways to minimize your taxes. So the biggest question, this all changed with the 2018 tax bill. And what it did was create a much more confusing situation. And unfortunately, a lot of people are becoming aware of that right now as you're starting to do your 2018 taxes. So the reason for this session is to see if we can come up with some strategies that will help you for 2019's taxes. Basically, other than IRA contributions, which you can still make up until April 15th, or if you are part of a company and you control the profit sharing, those can be made up until October the 15th if you file an extension on your taxes. Then basically the hay is in the barn, as they say, and there's not much that can be done to minimize your 2018 taxes. So what did happen and what is that going to look like for 2019? So your standard deduction did double. So some people who previously itemized their taxes as opposed to taking advantage of the standard deduction suddenly discovered that they didn't have enough deductions to itemize anymore, because the standard deduction went from $6,000 to $12,000 for 2018 and to $12,000 if you were married filing jointly. Well, it is going to get a slight bump for 2019 from $12,000 to $12,200 if you're single, and to $24,400 if you're married filing jointly. So in order to itemize, you would need to have deductions greater than, in the case of married couple, $24,400. One thing that is going to change for 2019 is that medical expense barrier is going to go back to where it was in 2016. So up until 2016, you could only deduct qualified medical expenses that exceeded 10% of your adjusted gross, if your total expenses exceeded 10% of your adjusted gross income. For 2017 and 18, that number had gone down to 7.5% of your adjusted gross income. For 2019, it's going back up to 10% of your adjusted gross income. So, for example, if your adjusted gross income is $100,000, you will only be able to deduct your medical expenses if they are more than $10,000. For many reasons, obviously, we hope that is not the case, but if you are hit with large medical bills, that's what you're looking at, an increase from that 7.5% of AGI last year up to 10% this year. The biggest and I guess most controversial part of the tax bill for a lot of people has been what they call SALT, state and local taxes. So that's your property taxes, your income taxes, your sales tax. As of 2018, that amount that you could deduct on those three categories was capped for the first time at $10,000. That number is not increasing for 2019, so it will still be a cap of $10,000 for any property, income, or sales tax that you wish to deduct. Mortgage interest. This has been the subject of many discussions. So up until the new tax bill, you could deduct mortgage interest on primary and secondary homes up to $1 million worth of mortgage. So if you had a mortgage that was $1.2 million, you could deduct the first 5/6 of the interest that you paid. Now it has been reduced for 2018 and stays there for 2019 down to $750,000 of mortgage on your first or second home. So you can take the deduction for any interest you pay on mortgages on your first or second home up to a total balance of $750,000. One of the questions that arose initially out of the bill was that home equity was not going to be allowed. That is not the case. So it has been ruled that home equity lines or home equity loans that were taken to significantly improve the value of your home. So if you took a home equity line and you bought a car with it, that is still not deductible. If you took a home equity line or loan and built an addition on your home or refurbished your kitchen or built a garage, any of those things are deductible up again to that cap of $750,000. So it's cumulative. So if you have a $600,000 loan on your house and your home equity loan is $100,000, that puts you at the $700,000, you'd be able to deduct all of your interest. If you have a $700,000 mortgage on your home and you have another $100,000 of home equity, only $50,000 worth of that home equity or half the interest you'd be paying would be able to be deductible. So that is a change in that tax law from 2018. The other thing that a lot of people are talking about is what happened to my charitable deductions. So for those who can't itemize because of the standard deduction doubling, there is no way for you to take a deduction for your charitable contributions if you stay under that total amount of $12,200 for your standard deduction single, $24,400 if you're married. However, if you are itemizing, your ability to deduct charitable deductions actually went up, or to realize charitable deductions. Previously, you could deduct up to 50% of your adjusted gross income. Now, obviously, those are some pretty big donations usually, but that number has gone up to 60%. So if it is someone who is extremely philanthropic or charitably inclined, then their ability to contribute actually went up from 50% of their AGI to 60% of their AGI. So another one would be casualty and theft losses. So casualty and theft losses Those used to be deductible if they were over $100 up until the new tax law. You no longer can deduct any casualty or theft losses that you incur. The other thing that changed was miscellaneous deductions. So your miscellaneous deductions used to be able to itemize up to 2% of AGI for miscellaneous expenses, things like unreimbursed job expenses, investment expenses. So if you should happen to pay your investment advisor to manage your money, for example, tax preparation, hobbies, those things were all deductible and itemizable. That is not the case, and especially the unreimbursed job, that has a lot of effect on a lot of people. So that 28-cent a mile deduction you used to be able to take just by tracking your mileage, that's not deductible anymore. So an important thing to be paying attention to, and a big surprise for a lot of people when they went to file their taxes this year. I must have heard from 10 people who were surprised to hear that. So that is a big change as well. Gambling losses, those are still deductible and itemizable, and investment interest as well. So if you are borrowing money in order to make your investments on margin, not always my best recommended scenario, but if you are, that is still deductible against your income. One other thing I wanted to talk about on the charitable piece. So if you are charitably inclined and say you give, I don't know, $5,000 or $6,000 a year historically, but you've got some cash lying around or you've got some appreciated investments, and you know eventually you'll take from those over the next 3 or 5 years to give that money away, but you wouldn't normally give away that much money in 1 year, you can start what is called a donor advised fund. You can make a lump sum. So let's say you give $5,000 a year. Geez, that wouldn't normally be deductible for me because I don't get above my $24,400 standard deduction. But I know I'm going to give that $5,000 every year for the next 5 years, and I've owned this S&P 500 fund that's gone up a lot over the last 10 years. I want to avoid my capital gain, and I'd like my charitable deduction to be still deductible, or my charitable contribution to be deductible. You can open a donor advised fund, put $25,000 into that fund, say, preferably of an appreciated stock, thereby you've avoided the capital gain of selling the stock to make the charitable contribution. And you can take that deduction all in the first year. So that $25,000 now is deductible because you got above your standard deduction. Now, I'm going to assume you have some other expenses. You want to make sure that it's not just, oh, I beat my standard deduction by $600. Obviously, you want to have some other things, mortgage interest, taxes, etc., and you likely would. You can then choose to keep that money invested, either in the existing fund or something else, and you can dole that money out as you see fit. Now, you may have thought you were going to give away $5,000 for the next 5 years. You might decide to give $2,500 for the next 10 years, or 10, 10, and 5, or however you decide to do that. But you've created a charitable deduction by putting that all into 1 year. So it's just another thing to be thinking about based on where we are in the economic cycle, what the market's done, and what your opportunities might be to minimize your taxes. So something to think about, certainly something. If you have any individual questions, you can reach out to us, and we'd be happy to help you think through those situations or to get you set up with a donor advised fund if that were appropriate. Paycheck savings, where can you take advantage of pre-tax savings and contributions? So obviously, a couple things. One, make sure that you're claiming the right number of dependents and getting the right number of deductions taken out of your check. I know a lot of people got surprised this year by the changes in the tax law and how much they had to pay. Supposedly this was a tax cut, but I haven't found too many people that actually realized it. They're all telling me that they're paying more. The other thing would be thinking about your retirement plans. So should I be doing a pre-tax contribution into my retirement plan? You know, it's long said that you should be saving between 10 and 15% of your income in order to realize, be ready for retirement. And so are you taking advantage of that? How much does that minimize your taxes by putting that money away ahead of time? So things to be thinking about there. Roth versus traditional 401k. So this is something that I think is the biggest change for me that people didn't talk enough about. So whether taxes are lowered or not, the marginal tax rate is the lowest it's been in history. And if you think back to how much the marginal tax rate was in the early 70s, it was over 60%. Right now, depending on where you live, it's the highest marginal bracket is 40%, 45%, whatever your state adds on, 50% if you're in California. But it's still lower. So thinking about where taxes are likely to go in the long term, likely higher at some point, especially if you think about how much debt the country is racking up, unfortunately. So if that be the case, that Roth, the ability to put money away in a Roth 401k where you're paying your taxes now at the lower marginal rate in theory, and to be able to take the money out on both your original investment and your growth 10, 20, 30 years in the future when you retire at likely higher tax rates and not paying those taxes can be extremely valuable. So up until the new tax law, I used to tell people the appropriate way to invest in defer into their 401k save, in my opinion, was to maximize how much money they were putting in. So if they weren't going to get to the annual maximum, which this year, by the way, will be $19,000 for an individual into their 401k, if you weren't getting anywhere near that, then you wanted to do pre-tax money, because the ability for more money to get in there, because most people make the decision to save based on how much they can afford to lose out of their paycheck. So if you can afford to lose $50 out of your paycheck, you'll say, I'm going to put $50 in. Those $50 in pre-tax dollars means probably $75 really going into the 401k. If it's Roth, only $50 are getting to work, those true $50. So making that decision often drove how much was going into the account. Therefore, getting more money to work and allowing that to compound over the next 10, 20, 30 years was more valuable than the tax savings, in my opinion. If you got anywhere near the maximum, I started talking about hedging your bets, and maybe you do half your money in pre-tax and half your money in Roth. Well, now with the current tax break or tax reductions, I believe that aiming towards Roth is that much more valuable, because it's likely that the tax rates will be significantly higher when people go to retire in 10, 20, 30 years. So to my opinion, looking at whether you're putting into Roth or traditional and making a new decision on that is important. So again, if you have questions, reach out to us. We're happy to help walk you through what the math is on a day-to-day basis, a week-to-week basis, and what that math looks like over the life of your 401k account. So feel free to reach out to us. Here are a couple of things that changed as well, job hunting expenses. So up until 2018, you could deduct any expenses for both looking for your job and for moving for your job. Those have been removed. So job hunting expenses no longer deductible. Moving expenses only available to some military families. I don't know why it's not all. I apologize. That isn't within the scope of this discussion, but some military families can have the moving expense deduction, but no longer for non-military or civilian people. Energy efficiency. So there are still significant credits available for solar work and geothermal work if it's a residence you live in. So you do not get a deduction if you make a solar improvement to a rental property. However, if it's a property that is either your first or second home that belongs to you, you can get a deduction up to 30% of the cost of an install in 2019 for solar boilers, solar panels, geothermal, all those things. So looking into that can create some significant savings for you, and maybe makes a project worthwhile that might not have been if you weren't getting that tax deduction right then and there. The cost of solar might be marginal versus what you would normally pay. That tax deduction can make a big difference. We discussed a little bit about charitable deductions earlier. Donating your appreciated assets. So again, market has had a big run here. I know it's off the last few days, but we're basically 3 or 4% off the all-time high and the longest bull market in history. So if you have had if you are charitably inclined and you've had significant increases in items in your portfolio, rather than paying a capital gain tax yourself and then cutting a check to a charity, it might make sense to donate that appreciated stock or bond portfolio to them, and you can take a look at those things. And also track your expenses for charitable work. So those are things to pay attention to as you're gathering up your charitable deductions and trying to get up to a limit that is, or your charitable contributions and making them deductible. The time that you spend can still be counted in amongst your taxes. Marriage and divorce. So planning your wedding to avoid the quote-unquote marriage tax. I don't know how popular that is, but if you're planning getting, thinking about getting married, sometimes pushing it out another year can make a significant difference in your tax. If you're getting divorced, things to look at, monitoring your tax basis on anything that is getting split up. So knowing that while assets are distributed equally, hopefully, or however they should be distributed appropriately, that tax basis as well. So make sure that you're not getting stuck with a significant capital gain, even though the asset value the gross asset value might be similar. The net asset value once you've sold and paid taxes might not be similar. So things to be paying attention to. Also, as of 2019, or any divorce that was finalized after December 31st of 2018, alimony is no longer deductible by the payor, and it is no longer reported as income by the payee. So significant differences there for anyone getting a divorce. Children. So first piece of good news I feel like I've been able to give you, the child tax credit did increase for both 2018 and 2019. It was formerly $1,000. It's now $2,000 per child. So that was increased. And if you're looking into adoption, the adoption credit went up to $14,080 for 2019. That is an increase from $13,800. I do wonder how these numbers come about. $14,080. Apparently, $14,000 even wasn't available. Again, looking at rules around your home, we talked about the mortgage deduction and how you get that. The sale of your house. So if you're thinking about selling your house, you will owe capital gains on the sale of your home above, if you're an individual, a $250,000 gain, and if you're married, a $500,000 gain. So if you bought a home, let's say in 20 years ago, and you paid $200,000 for it, and now worth $800,000, and you're a married couple, you would have a $600,000 gain. $500,000 of that would be excludable. On the additional $100,000, you would owe long-term capital gains, which right now is about 20%, including Mass State. So that would be a tax bill of about $20,000. So, but you do get that exclusion: $250,000 if you're single, $500,000 if you're married. So things to be thinking about when thinking about selling your home and what your net dollars in your pocket will look like. Questions about a vacation home versus a rental. What makes something a vacation home versus a rental? So if you rent out your home and it's rented for 14 days or less, you do not have to report the income to the government. If you use your home more than 14 days or 10% of, or is rented less than 10% of total days, or if you use it less than 10% of the number of days you rented it, whichever is greater. So if you use it more than 14 days in a year, or less than 10% of the days you rented it out, whichever number is greater, then it's considered personal. So if it's less than that, then it's considered a business. So that becomes whether you can deduct your interest. So again, talking about, back to my original discussion about what you can do with the mortgage deduction, if it's a personal residence, that's deductible there. If it's considered a business, then you're deducting it against any income you received. So things to be thinking about and get some advice on. And then tax-free exchange for rental. So that would be what's called a 1031 exchange. So if you own a property that you've been renting out and earning income from, and you decide to sell it, and you would have had a capital gain there, you can roll that whole amount into another property, one which you must identify within 60 days of the sale of the first property. It needs to be similar, so you can't take a single family home and go buy a apartment building. There are a number of other rules around it, but that's something to think about. So if you are thinking about getting rid of an investment property, but you don't want to pay the taxes, but for some reason that particular property is no longer attractive to you, but you're okay staying a landlord, you can do that tax-free exchange, and that is something to be paying attention to. Your investments. So advantages of tax savings when it comes to long-term investments. So obviously long-term capital gains are significantly less than short-term capital gains. Long-term capital gains get charged at, as I mentioned before, 20%. And short-term capital gains are charged as ordinary income, so roughly 40%. Another thing to be thinking about, and one that we see advisors miss all the time, is asset location. So a lot of people will put together a portfolio and say, geez, I should be 60% in stocks, 40% in bonds, or 65% in stocks, 35% in bonds, whatever that is. And then each individual account, their taxable account, their own IRA, their spouse's IRA, their 401k, each one gets that same allocation of 60% stocks, 40% bonds, or whatever. At the end of the day, it's all your money. So what you want to make sure is your household level is 60-40, but how am I most efficient from a tax standpoint? So bonds pay interest. High-yielding dividend stocks pay dividends every year. Putting those things into a tax-deferred account like an IRA or a 401k can make sense. So maybe your IRA is actually 100% in bonds or dividend-yielding instruments, and your taxable account is 100% in stocks, or whatever that ratio might work out to. But being able to defer that income year after year after year. So let's say you have a high yield bond that pays you 5.5%. Doesn't sound like high yield, but it is these days. So, and you've got $100,000 in there. So you're getting $5,500 a year in income. If it is in your taxable account, you need to pay taxes on that every single year, and you lose some compounding. If it is in a tax-deferred account, then that tax is not paid year after year after year. You do pay ultimately on the total amount when you go to take it out as income, but you're able to defer those taxes, and therefore that whole 5.5% growth, that whole $5,500 is working for you the next year, and then the next year, and then the next year. So that power to defer can be very valuable and is, again, missed by most advisors. So something for you to be thinking about. So ask about asset location if you're having those conversations. Another thing that isn't on the deck but should be talked about from an investment standpoint or a savings standpoint, most people who put money into a retirement plan at work, a 401k, a 403b, whatever it is, don't realize that even though they may not be eligible to do a deductible IRA contribution, if you do have that money lying around, and for 2019 it's $7,000 if you're over the age of 50, $6,000 if you're under the age of 50, or anything less. If you have that amount to put into an IRA, you can make a non-deductible IRA contribution. So you're not going to get the power of the tax deduction. You won't minimize your contribution to the government, as we spoke about earlier. But what you will do is you will get that tax deferred growth. So instead of saving it in a taxable account, you get the ability to grow that money year after year after year without having to pay taxes annually. So it can be a much, much smarter way of saving. I can tell you, people who make those non-deductible contributions annually have 3 to 5% better outcomes in their financial plans when we look at it than if they were to be saving in a taxable account. So just some things to think about. Hopefully we made your time valuable today. I want to be mindful of your time. It is exactly 12:30, and I promised it would be a 30-minute webinar. So how can we help? You can get in touch with us. Obviously, most of you know we have offices in Concord and Boston. That is my phone number there, 978-318-9502. You can email me at dave@12, spelled out, TWELVE, pointswealth.com. And I'm happy to help, whether there are questions on minimizing your contribution to the government or any other financial questions you have. Please feel free to reach out. I hope this was valuable for you today, and we look forward to seeing you on the April webinar. Thanks very much, and have a great day.